Jerome Powell sounded a little bit different at Jackson Hole. Did he just say cuts are coming?
Not exactly, but it does seem like he's thinking differently about the inflationary impact of tariffs, and we think that opens the door for the Fed to deliver 4 to 6 rate cuts between now and the end of 2026.
It looks like the case against most of President Trump's tariffs is heading to the Supreme Court. Does that mean they're going away?
It just means the Trump administration may have to find a different legal reason to enact the tariffs. More importantly, a large chunk of the tariffs the Trump administration has collected thus far may end up getting refunded.
Hello and welcome to the Outlook by SageView. That's right, we are excited to announce that we are formally a part of SageView Advisory Group, and we are looking forward to continuing to bring you our market insights right here. So Mike, let's get right into it. Global equities continue to rally, S&P 500 up nearly 30% since early April. Begs the question, what could throw this off track? And what we've talked about, what kind of comes to mind first for most people is slowing economic growth, weakening labor market. But we just haven't seen the level of firing to indicate that the labor market could be heading towards a recessionary type environment. So let's take it all the way to the other end of the spectrum. Maybe it's not a bad thing that's going to end this market rally. Maybe it's too much of a good thing. So let's start by talking about the Fed, and then we'll get into fiscal stimulus as well. But the Fed, what's happening with the Fed since Jackson Hole?
So we've been saying for quite a while that the Fed is good for 4 to 6 rate cuts between now and the end of next year. And even though they've been saying that they want to keep policy sort of where it's at, be patient, we thought that they would be willing to look through any increase in inflation caused by tariffs and focus on slowing economic growth and cut rates, sort of treating any inflationary shock from tariffs as one-time or transitory. And sort of the captain of that view within the Fed was Chris Waller, governor from New York, who now appears to be the front runner to replace Jerome Powell as Fed chair next May. And it appears that since the July Fed meeting, in between the July Fed meeting and the Jackson Hole Symposium, Chris Waller formally recruited Jerome Powell to join Team Transitory because in Jerome Powell's remarks, he says, a reasonable base case is that the effects will be relatively short-lived. This is referring to inflation or a price shock caused by tariffs. A one-time shift in the price level. Mm-hmm. So that to us means, we thought they just needed an excuse to look at tariffs as a transitory shock to the price level. That excuse was the weak labor market data that we got in July and the revisions to the May and the June report. And we think the labor market is weak enough that it's going to give the Fed that excuse to cut rates in September and in October and in December. That's 3 of the 4 to 6 cuts that we are forecasting between now and the end of next year. And then when Jerome Powell is ultimately replaced next May, whoever becomes the Fed chair, perhaps Chris Waller, probably is going to say, well, let's go ahead and finish the job here.
Presumably, yeah.
3 more cuts to get us to the quote unquote neutral federal funds rate, which is estimated to be around 3%. So I'll just go ahead and take care of those. So you're talking about 4 to 6 cuts. The question is, how stimulative will that be? Could it possibly be too much? And we think, 4 to 6 cuts is, one, it's a lot.
Yeah.
And especially when you're not seeing typical recessionary type signs firing like we would normally see in a recession. But also, if you look at the starting point of the economy, cuts in this cycle we think are going to be pretty stimulative. Just sort of less is more if you're thinking about stimulating the economy.
Yeah, something we talked about in detail in one of our deep dive videos when the Fed first started cutting back in fall of 2024. But yeah, it all has to do with the conditions, the environment that they're cutting into. Mm-hmm. The first of which just being the general looseness of financial conditions today. Mm-hmm. Contrast that with the Fed's belief that monetary policy today is restrictive.
Yeah, the Fed thinks they're being restrictive, meaning they're keeping the Fed funds rate at a level high enough that it's constraining economic growth. It's tightening financial conditions, stalling out credit creation, whatever. But if you run that point of view by the market, the market would say, what are you talking about?
Yeah.
If the stock market's at an all-time high, credit spreads are historically tight, the US dollar is weakening. Broadly speaking, you look at all those things together in a financial conditions index, there are a number of them. This is the one from Bloomberg. And financial conditions are loose. They are very loose. And if you cut rates, if you're the Fed, especially if you cut them 4 to 6 times, financial conditions are just going to get looser. So you're starting from a standpoint where financial conditions, broadly speaking, we don't think are restrictive at all. And then you're loosening them further.
Yeah. And you take that environment view and you take it a step further and start looking at the consumer or how these cuts could impact other areas of the market. And again, this is a great environment to cut into, right? You have a significant amount of assets in money market funds and you have consumers with a capacity to borrow.
Right. So money market fund assets are about a quarter of the size of the economy. That's near record highs. We saw them higher in 2008, for example, but in terms of dollars, we're certainly at more money sitting on the sidelines than we've ever seen in history. And as the Fed cuts interest rates, that's going to lower the yield on those money market funds. So if you're sitting in a money market fund, you may look at that and think, well, I don't want to keep my money parked here anymore. Maybe I go spend it, or maybe I invested in riskier things, longer term bonds or stocks or whatever. So once again, just a few cuts could have a big effect given how much cash is on the sidelines. And then if you're a household, you have the capacity to take on more debt. Household debt service ratios are very low. They're not as low as they were during COVID. That was record low, but they are the lowest they've ever been at the start of a rate cutting cycle. So it's not a capacity issue as to why consumers aren't taking on more debt. It's a willingness. They're not willing because debt is so expensive. If the Fed makes that debt cheaper, they will be more willing to take on debt. More credit is created, stimulates the economy. So an incredible starting point if you're looking to stimulate economic growth through rate cuts.
Right.
The question is, how much do you need? How much is too much?
Yeah, exactly. And all we've talked about here is the monetary policy side of the equation, right? Fiscal policy is a whole nother animal. Another deep dive video we did earlier this year was on the One Big Beautiful Bill. And we talked about how if that is going to be stimulative in its 10-year life, it's going to happen in the first half of 2026. One of the primary ways is through some pretty historic individual income tax refunds.
That's right. So we estimate about $412 billion in total tax refunds in 2026, spring 2026. So those are refunds. And at that point, individuals will probably adjust their withholdings. So they'll be taking home more cash, depending on their income levels. That number, 412 billion, of course, that's a record high. But even if you were to look at that as a percent of current GDP, that's about 1.4%. If you look at that on an average income tax refund basis, that should equate to about $500 more per household next year than this year. And this year was a pretty good year. So all in all, that's a lot of stimulus. That's big fiscal stimulus. 1.4% of GDP, the question would be, how much of that is going to get spent in the current period? Mm-hmm. Not all of it. Right. You know, a lot of it will be saved, and it depends on who gets it. Higher income households are more likely to save their refund. Lower income households are more likely to spend it. But even if you say half or a third of that gets spent, that will be hitting the economy at about the same time that these rate cuts that are starting in September will be hitting the economy. And all of that just so happens to be right before midterms.
Yeah, good timing, right? And of course, it wouldn't be a 2025 Outlook video if we didn't talk tariffs in one way, shape, or form. It looks like we're heading towards a Supreme Court case regarding about half of the tariffs that the administration has implemented, all those related to the International Economic Emergency Powers Act. As we've talked about a lot throughout the year, tariffs, a drag on economic growth. Somebody has to pay for it. But if these tariffs get overturned and refunded, that would be an opposite impact to economic growth, right? How should we think about that?
Yeah. So it looks likely the Supreme Court will take up the case. If they do, it seems like they'll rule on it sometime in early 2026, maybe March, possibly as late as June. And if we forecast out total tariff collections out to next June, and we segment them into the IEEPA tariffs versus the non-IEEPA, there'll probably be about $300 billion worth of IEEPA tariffs collected by the Trump administration from February 2025 through June 2026. If all that gets refunded, you're a company that's been paying into this and you get a refund check, how are you going to think about that?
Yep.
This will not be as stimulative as income tax refunds, that's for sure. We think it's logical that a lot of companies would look at that and say, I know other tariffs are coming.
Right.
The Trump administration is going to end up administering these IEEPA tariffs in some way, shape, or form through other lawful means, whether they're Section 301 or some other means, sectoral tariffs. So you're thinking, I got this refund, but I know I still have to pay tariffs. I'm going to spend this money on avoiding future tariffs, whether that's reconfiguring supply chains, reshoring production, whatever. Those are probably going to be big investments. So not all of the $300 billion will get spent right away. It'll be sort of invested over time. And the rest might be my tariff piggy bank.
Right.
Just to pay future tariffs, which will not stimulate economic growth much, if at all. So the $300 billion, that's about 1% of current GDP. We think it'll be less stimulative than the income tax refunds because most of it will just go to pay future tariffs. But if the Treasury has to refund $300 billion in tariffs, that means they have an additional $300 billion budget gap that they need to fill. And we've been talking about this budget gap for a while. That's going to be opening up at the end of this year, so early fiscal 2026 if you're the US government, out into fiscal 2027 even. And you just add another $300 billion on top of it. Do you have to start increasing auction sizes? So to us, if we put a bow on this whole thing, economic slowdown looks like it's going to happen at least until the end of the year. That should give the Fed an excuse to cut rates. And the equity market doesn't seem to fear that. But all of this stimulus, the rate cuts, plus the income tax refunds, plus potentially IEEPA tariff refunds are going to be hitting the economy right before midterms, sometime first half of 2026. And you add onto that budget concerns and concerns about perceived deterioration in Fed credibility. And what you could then see is rising long-term bond yields. And rising long-term bond yields, the last time, any time in recent history that you've seen the 10-year Treasury move quickly from 4.25% or 4.5% up to 5%, the equity market has really struggled. So we think that is a plausible scenario and something we're definitely looking out for as we head into 2026. The thing is, markets are forward-looking. Do they start to price in this scenario sooner rather than later? They might not even wait until early 2026 to do this. So the way we're looking at it when we're managing risk for portfolios is under 4.5 on the 10-year is sort of a green light. 4.5 to 5 is yellow. And if we hit 5% yield on the 10-year Treasury yield, that we think equity market investors are going to take as a red light.
Well, that will do it for this edition of the Outlook by SageView. If you have any questions or comments, please feel free to reach out.